Google is pursuing a structured capital deployment strategy to expand the market for its tensor processing units beyond its own cloud platform. Through equity investments in Neocloud operators, credit backstops for the data center partners, and direct chip sales, the company is building an alternative distribution ecosystem. A necessary move given that the rival hyperscalers have little incentive to adopt chips from a cloud competitor. And the hardware case is strengthening. Google's Ironwood TPU now approaches Nvidia's Blackwell on key performance benchmarks while offering a substantial cost of ownership advantage, according to semi analysis. But the path to meaningful market share faces formidable headwinds also. TSMC manufacturing constraints, Nvidia's 80% grip on the data center accelerator market, and a software ecosystem with 4 million developers and millions of customer signals. When we are talking about the mixed customer signals, we have Anthropic expanding the TPU usage while Meta has doubled down on Nvidia. Custom silicon may capture 15 to 25% of the AI chip market by 2030. But whether Google's TPUs can anchor durable external demand beyond the subsidized partnerships remains a critical test. Hello everyone, welcome back to our channel and welcome back to this video. In this video, we're going to focus on the TPU Gambit and Google's bid to buy its way into the AI chips race. Nvidia commands upwards of 80% of the data center AI accelerated market, and its CUDA platform locks in over 4 million developers. Google's answer? Deploy its balance sheet to subsidize an alternative distribution ecosystem for its GPU chips. Here's why it's harder than it sounds. Let's talk about how subsidizing can be a distribution mode. Now, Google has historically sold access to its tensor processing units through its own cloud platform. That limited the audience to customers already committed to Google Cloud. Now the company is pursuing a different playbook altogether, using equity stakes, credit backstops, and direct hardware sales to seed TPU capacity across a network of independent infrastructure operators that sit outside the traditional hyperscaler ecosystem. In a recent article, Wall Street Journal reported that the centerpiece of this push is a potential $100 million investment in Fluidstack at a valuation of approximately $7.5 billion. Now, Fluidstack is a part of the fast-growing Neocloud segment that the research firm Modern Intelligence sized at $24 billion in 2025 and projects to reach $237 billion by 2031, growing at 46% compound annual rate. These specialized providers offer GPU and now TPU-based compute to AI companies at lower cost and faster processing times than the large cloud platforms. Cipher Mining has disclosed that approximately $3 billion in contract value is tied to its Fluidstack arrangement, with a reported $1.4 billion Google credit backstop. TeraWulf secured a 10-year 360-megawatt lease with Fluidstack at its Lake Mariner facility, also backed by Google's credit enhancement. These are not venture bets. These are structured infrastructure finance designed to reduce the risk for operators willing to build TPU-based capacity. Now, the strategic logic out here is pretty straightforward. CoreWeave, the largest Neocloud operator with $55.6 billion backlog, built its business almost entirely on Nvidia GPUs and counts Nvidia as a direct equity investor. Google needs a comparable anchor in the Neocloud layer, and Fluidstack's willingness to serve as a TPU as a service platform gives Google something that it has lacked: a third-party distribution channel with no competing cloud business. However, there is also a competitor and customer paradox that we need to look into. Nvidia's most powerful structural advantage is not silicon, it's neutrality. Nvidia sells GPUs to every major cloud provider without operating a competing cloud service. AWS, Azure, Google Cloud, and Oracle all deploy Nvidia hardware at massive scale. This means Nvidia's total addressable market is the entire cloud infrastructure industry. However, when Google is concerned, it faces the opposite dynamic. Its most obvious wholesale customers for TPU chips, the other hyperscalers, are simultaneously its fiercest competitors in the cloud services. Amazon has invested heavily in its own custom accelerators, including Trainium and Inferentia. Microsoft is Nvidia's largest cloud partner. Neither has an obvious incentive to funnel billions of dollars towards a rival chip program. Industry participants characterize interest from competing cloud providers as minimal. And this paradox is something that explains the appeal of the Neocloud workaround. The roughly 100 Neocloud operators worldwide do not compete with Google in cloud services. They complement it. However, it also explains a persistent internal debate that has recently resurfaced: whether to spin the TPU team into a structurally independent unit. Now, a standalone entity could raise external capital, form partnerships without the taint of competitive conflict, and potentially sell to customers who refuse to buy from Google Cloud directly. Google says that it has no plans for such a restructuring, arguing that the integrated development between the chip team and the Gemini model team allows for tighter hardware software co design, a legitimate advantage. Still, the fact that this conversation reoccurs signals that the company recognizes the structural ceiling that its current organization creates. Let's also talk about the manufacturing bottlenecks and the TSMC queue. Now, compelling hardware specifications mean little without the ability to produce at scale. Google partners with Broadcom on the TPU design and relies on TSMC for the fabrication. Both relationships create dependence that financial investments cannot easily resolve. TSMC's advanced packaging and process node capacity is currently under enormous strain from the AI-related demand. Nvidia is TSMC's single largest customer and by extension receives preferential allocation when the capacity is tight. For a challenger that is attempting to ramp volumes, this creates a structural bottleneck. TrendForce projects that Google's TPU shipments will remain the highest among the cloud service providers that provide custom silicon, with over 40% annual growth expected in 2026. But the highest among custom silicon producers still represents a fraction of Nvidia's total GPU output. So what can be said is that Google cannot will its way past the foundry constraints, and the financial backstops that it is offering to the Neocloud partners assume that sufficient hardware will be available to deploy. The demand signals have been encouraging but uneven. The customer evidence is real but mixed. Anthropic has committed to assessing up to 1 million TPU chips through Google Cloud, and its head of compute has publicly endorsed Ironwood's price performance characteristics. The broader Anthropic Fluidstack relationship reportedly involves a $50 billion infrastructure partnership to build custom AI data centers. The first phase of the TPU arrangement alone is estimated to cover 400,000 Ironwood chips. Meta also explored TPU adoption but subsequently deepened its commitment to Nvidia with purchasing plans valued in tens of billions of dollars. When we talk of OpenAI, it has pursued a multi-provider strategy, signing capacity agreements with AWS, Oracle, Google, Microsoft, and several Neoclouds, but Nvidia GPUs remain its primary training hardware. These decisions underscore a recurring dynamic. Companies may express interest in diversification, but Nvidia's software ecosystem makes switching very costly. As we wrap up this video, let's look at what the $320 billion capex cycle is telling us. The context for Google's TPU push is a hyperscaler capital expenditure cycle of extraordinary scale. Amazon, Microsoft, Google, and Meta collectively spent an estimated $320 billion on AI infrastructure in 2025, with most forecasts pointing to continued growth. This is the environment creating the opening for neoclouds and by extension for alternative chip architectures. However, what we have to keep in mind is that the same capital intensity that creates opportunity also creates bargaining power. Nvidia's largest customers are the hyperscalers themselves, and their willingness to commit tens of billions to Nvidia hardware each quarter reinforces the GPU ecosystem's dominance. Custom silicon from Google, Amazon, and others is widely expected to capture 15 to 25% of the AI accelerator market by 2030, concentrated primarily in the internal inference workloads rather than third-party training. Now, for Google, the question is whether the TPU adoption can move beyond the captive internal use and anchor demand at external partners, creating a self-sustaining ecosystem rather than one that requires continuous financial subsidy. AlphaChip, Google's reinforcement learning system for chip layout design, has been used on the last 3 TPU generations, including Ironwood, giving the company a feedback loop between the AI research and its hardware program that no other chip challenger can replicate. Now, whether that loop generates enough gravitational pull to attract external customers at scale is a multi-billion-dollar question. That's all that we wanted to share with you in this update. Hope you've enjoyed the video. Stay tuned in for our next update.